What if I told you that most traders who blow up their accounts don't fail because of the markets? They fail because they never truly understood how options actually work, how to use them, manage them, and trade them with purpose. That's it. If you don't truly understand how options work, you're not trading, you're just gambling. But once you master the foundations, calls and puts, everything else in the options trading starts to make sense. Strategies become clear, risk becomes manageable, and most importantly, you stop trading blindly and start trading with purpose. So in this video, I'm going to break down how calls and puts work, when and why to use them, and how to properly open and close option positions, and even a few simple strategies you can start practicing today. Let's jump in. This is actually the second video in our options trading series, a 5-part journey designed to take you from a complete beginner to a confident, capable options trader. If you missed the first video, make sure you go watch it before this one. That video covers the absolute core basics, what options are, why traders use them, and how options give you leverage, risk management, and income potential. This video builds on that foundation with slightly more advanced concepts, so make sure you're starting at the beginning if you're brand new. Let's start with call options. A call option gives you the right, but not the obligation, to buy 100 shares of a stock at a specific strike price before a certain expiration date. You're buying the possibility of buying stock cheaper later and locking that price up front. When you buy a call, you're betting the stock will rise above that strike price before expiration. If it doesn't, the most you can lose is the premium you paid. Think of it like buying a ticket to a concert. You're not committing to stay for the entire show, but you paid up front to have the option to go. If plans change or the band cancels, you're out of the cost of the ticket, nothing more. That ticket, just like the call option, gives you the potential for the upside with limited downside. Just like a ticket's price might depend on how soon the event is, how popular the performer is, and whether it might sell out, an option's price is based on similar expectations about time, movement, and demand. That brings us to what actually makes up the premium you pay when you buy an option. When you buy a call option, you pay a price called the premium, and that premium is your total risk. So what makes up that premium? It has two main parts. Intrinsic value, this is the real built-in value of the options. It exists when the option is already in the money. And extrinsic value, this is the added value based on two factors. Time value, which reflects how much time is left until expiration, and implied volatility, which measures how much the market expects the stock to move. Just like how concert ticket prices can spike if a show becomes widely popular and demand surges, options become more expensive when traders anticipate big moves, even if nothing has happened yet. The more excitement and uncertainty in the air, the more people are willing to pay for a seat. And that's exactly how the IV works in the options market. Intrinsic value is very straightforward. If your call option has a $100 strike and the stock is trading, say, at 105, your option has $5 of intrinsic value, or $500 per contract. But even if you're $5 in the money, the premium actually might be higher because of the extrinsic value. Time value is part of the premium that pays for opportunity. The more time until expiration, the more your option is worth, because that's more time for the stock to move in your favor. Let's say the stock moves slowly and the expiration is far away. Your premium may increase gradually. If it moves fast and early, your premium can spike because you're gaining intrinsic value while there is still plenty of time left in the option, and possibly an added boost from the rising implied volatility. But if it moves slowly and expiration is near, the time value just evaporates, and so does much of your premium. This gradual loss is called theta decay, and it chips away your premium day by day. The closer you get to the expiration, the faster that decay accelerates, especially in the last 30 days. Even if the stock moves in your favor, you might still lose money if it doesn't happen fast enough. Theta is just one of the several forces that affect how option prices move. These forces are called Greeks, and we'll break them down one by one in the next video so you know exactly what's impacting your trades. Implied volatility, the IV, is market's forecast of how much the stock might move. Higher IV means more expensive options. Lower IV means cheaper ones. Real world examples would be something like before earnings, because before earnings, IV spikes because nobody knows whether the stock will soar or crash. But after the report, IV often collapses, even if the stock moves. If you buy a call before earnings and IV collapses, you could lose money even if the stock moves moves in your favor. Bottom line, you're not just trading the price, you're trading timing, speed, and expectations. Let's start with the core concept in options trading, moneyness. Moneyness describes the relationship between an option strike price and the current price of the underlying stock. It tells us whether an option has intrinsic value and how likely it is to become profitable before expiration. There are three main types of moneyness. In the money, this is when the option has intrinsic value right now. At the money, this is where the strike price is equal to the stock price. And out of the money, where the option has no intrinsic value yet. Moneyness can change over time as the stock price moves. So out of the money option today could become in the money tomorrow, or vice versa. Let's say the stock is trading at $200 right now. A 190 strike call is considered in the money because the strike price is below the current stock price. This means it already has intrinsic value. If you exercise it right now, you could buy the stock at 190 and sell it for 200, capturing about $10 difference per share. Because of that built-in value, the premium for this option would reflect both the intrinsic value and any additional time or volatility pricing. A $200 strike price is considered to be at the money, meaning the strike price is the same as stock's current price. There is no intrinsic value here, but this is where the options typically hold the most time value. That's because there is still a 50-50 chance the stock could go either direction before expiration. Traders pay more for that possibility, which is why this at the money options tend to have higher premiums driven by time and volatility expectations. A 210 strike call is out of the money. The stock would need to rise above 210 for the option to have any real value. Until then, it has no intrinsic value, only extrinsic value. You're paying purely for the chance the stock makes a big move up before the expiration. These options are cheaper but also riskier because the stock has to move significantly for them to become profitable. If the stock rises sharply, out of the money calls can quickly shift into at the money and then into in the money territory. And their value can spike fast because you're gaining intrinsic value on top of the time value. But if the stock drops or moves sideways, even in the money calls can lose value as time erodes and IV falls. Here's a quick visual breakdown of how time value behaves for different strikes. At the money options, the orange line holds the most time value, but they also lose it fastest as the expiration approaches. Out of the money and in the money options have less time value to begin with, and their decay is slower and more linear. The closer you get to the expiration, the faster that time value disappears, especially for the at the money options. So understanding where your strike sits relative to the current price is key to choosing the right call option for your strategy. Now let's take a look at put options. A put option gives you the right but not obligation to sell 100 shares of a stock at a specific strike price before expiration. Puts are a powerful tools that traders use either when they expect a stock to go down or when they want to protect gains on shares they already own. It's like having an insurance policy on your portfolio. Imagine you own a vintage car worth around $20,000. You buy an insurance policy that says if the car crashes or loses value, you'll still get paid the $20,000. That's what a put does. If the value drops, your policy or your put becomes worth more. Now, let's say the stock is trading $200 and you buy a $200 at the money put. That means you've locked in the right to sell the stock for $200 no matter what. If the stock drops to $190, that put now has $10 of intrinsic value or $1,000 per contract. Why? Because you can still sell the stock for $200 even though it's only worth $100 on the open market. That's the built-in advantage of a put. It gives you downside protection or lets you profit when the stock drops, and you never have to actually own the stock to benefit. Just like the calls, put premiums are made of two things. First one is the intrinsic value when the strike is above the stock price, and extrinsic value, which is made up of time value and implied volatility. Puts gain value as the stock falls, and they can lose value as time passes or if IV drops. Theta decay still applies. If the stock doesn't drop in time, you lose premium even if you're directionally right. IV also spikes when markets panic and falls just as quickly when calm returns. The rise and fall can add or subtract a lot from your put's price. Let's take a look at the moneyness for puts. Assume a stock is at $200. A 220 strike put is in the money. It has intrinsic value because the strike is above the current market price. This means the option already gives you the right to sell shares for more than they are currently worth, and its premium will reflect that. A $200 strike put is at the money. It has no intrinsic value yet, but it has has the maximum time value because it's right at the stock price and has the most potential to swing in either direction. A $180 strike put is out of the money. It only becomes valuable if the stock drops below that strike price, making it a higher risk and lower cost option. Now, here's something that most traders overlook with puts. Even if you're right about direction and the stock falls, you can still lose money if you get the timing or volatility wrong. Puts lose value over time if the stock doesn't fall fast enough. That slow bleed is called theta decay. And then there is implied volatility, or the IV. Let's say you buy a put before earnings when IV is high. The company reports, the stock drops, but IV collapses. That's called an IV crash. And it can shrink your premiums even if you're right on the direction. Because in options trading, you're not just trading the price. You're trading speed, timing, and fear. Here's the common question that traders have. Do options entitle you to dividends? The answer is no. Options themselves do not pay dividends. If you hold a call or a put contract and underlying stock pays dividends, you won't receive it unless you actually exercise the call and become a shareholder before the ex-dividend date. So if you're trading around dividend-paying stocks, it's important to know that unless you exercise and own the shares, you're not getting that dividend. This catches many new traders off guard, especially when they assume owning calls means getting paid like a shareholder. Now let's talk about how exercising an option actually works. If you hold an option, you can choose to exercise it at any time before expiration. That's a feature of the American style options. Exercising means turning your option into a real stock position. If it's a call option, exercising means you'll buy 100 shares of the stock at your strike price. If it's a put, it means you're selling 100 shares at that strike price. But here's what most new traders don't realize. Very few retail traders actually exercise their options. In most cases, it makes more sense to sell the option before expiration. That way, you lock in your profits or limit your losses without needing the cash or the margin to handle 100 shares. Exercising is mainly used by larger investors or traders who are using options as part of a more complex strategy. Here's something really important to understand. Most brokers would automatically exercise your option if it's even 1 cent in the money at expiration. So let's say you're holding a call option that finishes 1 cent above your strike price. You might not plan to buy 100 shares, but your broker might still do it for you. And if you don't have the capital in your account, that can trigger a margin call or force a liquidation. Same goes for puts. If your put ends in the money and you haven't closed it out, the broker might automatically sell 100 shares on your behalf. So always manage your positions. Don't wait until the last second. If you're not intending to exercise, close the trade ahead of the expiration. Let's move from theory to practice. These are 3 foundational option strategies you can start using today. Whether your goal is to profit from movement, generate income, or build stock positions more effectively. Let's begin with directional trades. This is the most straightforward strategy. You buy a call option if you think the stock is going to rise, or a put option if you believe it's going to fall. It's like placing a bet on the direction, but unlike buying the stock outright, your maximum risk is just the premium you paid for the option. Now, here's where a lot of new traders overlook something important, especially when it comes to puts. Implied volatility, or IV, becomes a critical factor in how profitable your trade is. Think of IV like the cost of insurance. When the market is calm, volatility is low, and that insurance on your put is very cheap. But if fear enters the market and stocks begin to slide, volatility usually spikes. That means the value of your put can surge, even before it goes in the money, simply because other traders are now scrambling for protection. Let's say you buy a put when IV is low and the stock drops fast. You benefit 2 ways, from the drop in the price and from the increase in the IV. That 1-2 punch can make your option significantly more valuable. But here's the flip side. If you buy a put when IV is really high, like in the middle of a panic, and the stock doesn't fall quickly enough, IV can collapse. And when that happens, your option premium can shrink, even if you were technically right about the direction. So it's not just about predicting which way a stock is going to move. It's about understanding how quickly it moves and how much volatility the market is pricing in. Mastering that balance is what separates profitable option traders from the ones just guessing. Let's say the stock is trading at $100 and you buy a 105 call for $2. If the stock rallies to 112 by expiration, your option now has $7 of intrinsic value, making it worth $700. A $500 profit after the $200 premium. If the stock only reaches to 105 at expiration, the option expires worthless and you lose the full $200. Your break even in this example is 107. Moving to strategy 2, covered calls. If you already own 100 shares of a stock, you can sell a call option against it. This is a very popular strategy among among long-term investors who want to earn extra income on their holdings. You collect a premium upfront when you sell the call. If the stock stays flat or rises slowly, you keep the premium and your shares. If the stock jumps past your strike price, you still profit by selling your shares at that higher strike, and you still keep that premium. Covered calls work best in sideways or gradually rising markets. It's like renting out a room in your house, but you're still getting paid while you hold on to your asset. And finally, strategy 3 is cash secured puts. This strategy is for stocks you actually want to own, but you would prefer to buy them at a lower price. You sell a put option at a strike price, you would be comfortable buying the stock. You're required to have the cash ready, hence the name cash secured. If the stock drops to that level, you buy it at a discount. If it doesn't drop, you just keep the premium. Think of it like putting in a limit order to buy a stock and getting paid while you still wait for it. You're not chasing the price, you're letting it to come to you and getting rewarded for your patience. Now let's talk about how to actually open and close option positions. Opening an option trade is done by either buying to open or selling to open a contract. When you buy to open an option, whether it's a call or a put, it's called a debit trade. You're paying a premium upfront and that's your total risk. You do this when you're going long on an option, meaning you want the price of that contract to go up so you can sell it later for profit. When you sell to open, like when writing a covered call or selling a cash secured put, you're collecting a premium. That's a credit trade and your risk depends on the strategy. You're starting the trade by selling the option, and if it expires worthless or you close it for less than you sold it, you keep the difference as profit. To close either trade, you simply do the opposite. If you bought to open, you'll sell to close. If you sold to open, you'll buy to close. You don't have to hold options until expiration. In fact, most traders manage and exit trades early to lock in profits or limit losses. And here's a tip for you. Always monitor the bid to ask spreads, especially in lower volume contracts. A wide spread can eat into your profits or make it harder to exit quickly, especially in lower volume contracts. Before placing any options trade, whether it's a basic call or a more advanced strategy, you need to check 3 key things. This will help you avoid unnecessary losses and make sure you're entering with the right expectation. First one is the implied volatility IV. Check if IV is high or low compared to recent levels. High IV means options are more expensive. It's great if you're selling, but it's risky if you're buying. Also ask, what's likely to happen to IV after I enter? If IV collapses, like after earnings, you could lose money even if you're directionally right. Number 2 is time to expiration. Make sure you're giving your trade enough time to work. Short-term options lose value fast due to theta decay. Longer dated options give the stock more time to move, but cost more. Match the expiration to your expected timeline for the move. And finally, number 3 is the break-even point. Know exactly where the stock needs to go for your trade to turn a profit. Many new traders enter trades without realizing the stock needs to move a lot and quickly. Check your break-even price and ask, is that move realistic based on the chart? Now let's recap everything we just covered. Calls give you the right to buy a stock. Puts give you the right to sell. The price you pay, the premium, is made up of intrinsic value and extrinsic value, which is influenced by time and implied volatility. And that volatility part, that's where the real edge is. Because you're not just trading the price, you're trading timing, speed, and expectations. We also looked at 3 core strategies. Directional trades, simple bets on where the stock might go. You buy calls if you're bullish, puts if you're bearish. It's very easy to understand with defined risk and unlimited upside for calls if you're right. Number 2 was covered calls, a perfect for long-term investors holding at least 100 shares. You earn extra income while you hold your stock and potentially sell it at a profit if the stock moves higher. And finally, we have cash secured puts. It's great if there's a stock you want to own but at a lower price. You sell a put, get paid up front, and if the stock drops to your strike, you buy it at a discount. Next up in the series, we're going to talk about Greeks, the forces that actually drive these options from moment to moment. Delta, theta, vega, and gamma, once you understand them, you'll stop guessing and start making decisions like a real option trader. If this video helped clear things up, hit that like button, share with others, subscribe, and drop a comment letting me know your biggest takeaway. And if you're enjoying this option series and want to stay up to date with what's happening in the markets and maybe even catch a few high probability setups along the way, make sure to subscribe to my free newsletter. I send it out a few times a week with market news updates, real trade ideas, and charts I'm watching, and it's completely free. Because at the end of the day, this isn't about luck or hype. It's about building a real skill set, step by step with clarity, confidence, and consistency. Thanks for watching, and I will see you in the next one.